Red Thunder, guys. Aldi brand Red Bull. It tastes very similar and it's not quite as expensive as Red Bull. So I'll give you guys a little life hack here. I prefer the sugar free, but they're sold out like every time I go to the grocery store, which is usually on Sundays. So here's the thing, guys. It's been kind of a not the greatest day. Woke up a little late today. I was feeling pretty lazy. It is Sunday, and then my car wouldn't start. Okay, I had plans to go to the gym and get Chipotle, but obviously car trouble. That's never fun. That's a quick way to kind of mess up your mood, but that's okay. We'll get it taken care of. For today's video, I wanted to record. Initially, I wanted to do kind of a March stock, a March dividend stock that I'm pretty focused on and has my attention this month. If you guys have been on the channel, you saw in February we did a video on Hershey, kind of being that best stock for February. We visited Hershey, and I do want to do one of those videos each month. And I'm thinking kind of the structure is going to be, okay, we revisit Hershey. We look at if anything's come out in the past month since we visited it, and we talk about if there's any sentiment shifts. I do want to do that every month. However, today I would rather just do kind of a broad educational conversational video, guys. We're going to be talking about what to look for and what to screen for when finding and selecting winning dividend stocks, guys. I do want to acknowledge that every investor, every dividend investor is going to have kind of their own sort of risk tolerance. Okay. Some people might be more into ETFs. For me personally, I do like to pick individual stocks. But as you go along this game, you will kind of find out through trial and error what works for you, what doesn't work for you. And guys, I'm on here talking about my own journey. And sometimes I feel a lot of different people, on social media and stuff, they kind of come from this place of, this is how I do it. This is how you should do it. Guys, I want to encourage conversation. I want to encourage us to, become our own investors, let our own discretion and risk tolerance kind of shine through. So, in this community, we can all build the best portfolio for our own needs. With that being said, I'm going to talk through kind of what I personally like to look for. So we're using FinViz. They've got a lot of decent free data. And I've gone to their screener tab and I've gone to all. So what we're going to do, guys, is we're going to talk through, different sort of metrics you can screen for. And I'm going to talk about, okay, what value do I place on these? Do I really even pay attention to this? Okay, this means a lot to me. Okay, you guys get the gist. Let's go ahead and jump into it. Market cap. I'm going to go ahead and select greater than mid cap. Okay, because if you guys have been with my channel, a lot of my holdings are large caps, and that's typically kind of my wheelhouse. However, I don't want to put myself kind of in a bubble and maybe miss out on a great mid cap that has kind of, dedicated some of their free cash flow. They've put in kind of a dividend growth plan. I don't want to overlook any mid caps. So I'm going to do mid cap and large cap here for market cap. EPS growth over the past 5 years, guys. All I'm going to put here is positive. Okay. And I'm going to explain why. We've talked about it before, but this is kind of my philosophy on things. Every stock or investment, is going to take a certain type of lens. Okay. We're dividend investors and we're going to have to use a different lens for different types of stocks. And, different types of stocks can serve a great role in our portfolios. With that being said, maybe a more mature company that has, a long track record of dividend growth, they might not have that explosive EPS growth in the past 5 years, like we've seen with something like Microsoft or, I don't know, probably Broadcom, something like that, which are dividend growers who have done well. Maybe something like Altria or Pfizer has slower EPS growth. With that being said, guys, I just like to put positive. That way I'm not kind of, excluding types of stocks based on, what type of purpose they could serve. Earnings and revenue surprise. I just leave this at any. I don't get nitpicky here because I am a long-term dividend investor, guys. I personally am not too worried about if it's a beat or a miss on earnings and revenue quarter to quarter. I like to look at year over year data and kind of read, what story is the long-term story for a stock. Okay, so I'm not getting hung up here. Current ratio, this is going to be current assets divided by current liabilities. Again, obviously this is something we talk about in school, but if I can be frank, I do not use current ratio, in my investing strategy. Operating margin, we've talked about this too, guys. If you've been with the channel, we visited Walgreens. Wow, that was a great example of what can happen to, a dividend grower when they don't have an operating margin to cover, economic downturns or setbacks. Okay, we saw Walgreens, their margin was like 1% or maybe even lower. I can't remember anymore. So I'm going to be a little more nitpicky here on operating margin, guys. I don't want to just put positive here. I'm not going to be too over the top. Like, a company doesn't have to have like tech operating margins for me to invest in it, but I am going to go with over 20%, and that's going to give me that wiggle room, that confidence as a dividend investor. Institutional ownership, guys, based on your own personal risk tolerance, you can play with this one. But for me personally, not to say this is right or wrong, I try not to get too hung up on institutional ownership. I try not to get too hung up on, insider buying and selling, because while those can be indicators of something sometimes, there's also just going to be, for me, there's going to be too much noise with something like that. Does that make sense? Earnings date, we don't really care about that. Gap, I mean, we don't need to focus on if a company is gapped up or gapped down. Again, because we are long-term investors, guys. Ideally, the stocks in my portfolio, I'm going to hold for the long term, potentially my lifetime, and I'm going to enjoy that compounding. I'm going to enjoy my yield on cost. And, hopefully we can create a pretty sweet stream of income that grows. Okay. Change from open, no. Pattern, no. Volume, I'm going to leave this at any, just because if we already have mid cap and large cap stocks, I'm not going to get too hung up on daily volume. If something were to come up through the screener, okay, we could weed it out after the fact. IPO date, I mean, that's not really super important. Kind of the same thing here. It just doesn't really fit with what we're trying to do here. However, I could put more than 20 years ago, just because, again, I do typically like to focus on stocks with kind of that longer term track record as a dividend investor. So you could do whatever you want here. You can leave it at any, or you can put in, more than 25, 20 years ago. Single category. Yeah, we don't, again, this is something that is not really super relevant to the video today. Annualized return, I am going to leave this at any, because I don't want you to get caught in this kind of mindset of, okay, I need to screen for stocks that have had, a great 1 year performance or 3 great years of annualized return. And the reason why I don't want you to get hung up on that is, oftentimes stocks that haven't been performing the best, but still have those great underlying fundamentals. For us dividend investors, guys, that's going to create the best opportunities. Okay. Does that make sense? Do not get caught up on annualized return, because if you're buying something just because it's performed well, then in turn that could mean, okay, maybe it's time for a correction. And then you're going to be kind of at a place of, I didn't quite get the bang for my buck that I could have because I was greedy about some trailing 1 year return when, I wasn't even invested in this company in the past year. I felt like I explained that kind of, I overcomplicated that, but you know what I mean. Don't get too caught up on this. Let's focus on some other stuff. Index, you can leave that at any, because again, this market cap here, I think that's going to kind of kill. It's going to kill enough birds with one stone. PE, obviously we could do profitable. Again, back to this lens thing, guys. Different types of companies in different stages of the game or different sectors are going to have, different sort of normalized trading PEs. So with that being said, I'm tempted to leave this at any, but for sake of the video, let's try to pick something out here. I definitely wouldn't want to go like over 10. I'd want to pick one of these unders. But, some tech stocks can even get inflated PEs just because of explosive EPS growth. So, just to keep this broad, we'll go with under 25. You really don't have to worry about the PE in terms of screening, because when you're inspecting stocks and you're looking into it, you're going to be able to see, okay, what is their PE now? What has it been over the history or the past 5-year chunks we like to look at? And you'll be able to read kind of that story. So in terms of a broad screener, I really don't know if that makes too much sense to use. Nonetheless, price to cash, not going to worry about that. EPS growth in the next 5 years, again, I'm not going to worry about that because I'm more focused on real-time, 2-day opportunities, guys. And, sometimes people can get carried away with projections. And, in reality, guys, none of us really know what is going to happen in the next 5 years. A broad economic environment is going to have a huge effect on a lot of companies. So, don't get too caught up trying to project stuff. It's another thing I see on YouTube. I feel like people are like, this stock, they'll put a little arrow, 10x over the next 2 years. I'm like, bro, you don't know. So let's focus on current opportunities. That's what we do. We get bang for our buck so we can enjoy, hopefully, a compounding and growing stream of income, guys. I'm having more fun with this video than I thought I would. I feel like this is kind of turning around my day. So thank you guys for the support on the channel. It's really awesome. Next up, dividend yield. And this is an interesting one, guys. We are dividend investors. I can't skip over dividend yield. And I've spoke on it before. Kind of my wheelhouse for dividend growth is maybe companies that have been growing their dividend for 10 to 15 years, and they do have kind of that decent starting yield, and they do have a good amount of free cash flow to support that dividend. I'm going to go ahead and go with over 2% here, but again, these are just my preferences. Not to say that these have to be your preferences. Not to say that I don't break these rules, guys. I am a shareholder of Apple. I am a shareholder of Microsoft. Okay, so I make exceptions in either direction. But for today, I would probably we'll put over 3%. Again, this is a theoretical video. I'm not even sure what type of stocks we're going to get spit out. What are we even at right now? We have 60 total stocks. Let's keep going and see if we can screen a few more out. We already did operating margin, so I don't know if we need to cover net profit margin as well. Institutional transactions, again, I'm not too worried about that right now. Performance, I'm going to skip over that. Again, the long-term thing, 20-day moving average. Again, long-term, guys, I'm not too worried about the 20-day trend. I do like to use charts. However, for my dividend investing, I typically use charts with like weekly candles, okay? And that's my own personal tolerance. I know there's dividend investors who aren't really a fan of, really too much technical analysis, right? So let's keep moving. 20-day high low, no. Candlestick, no. Volume, again, large and mid cap and kind of after the fact, guys. This doesn't mean you're just going to buy any stocks the screener spits out, but this can kind of get you thinking, okay, what type of companies right now, what type of sectors, what companies should I be looking at? Sector, we're going to leave at any. Forward PE, we're going to leave at any. We already put PE. Price to free cash flow. This is a good one. I like this metric. I personally like using price to free cash flow better than using PE, just because I do feel it gives a more accurate representation of the relative valuation of a stock. And I say that because earnings sometimes will kind of miss the mark on telling the full story. They're usually pretty similar. But if I see price to free cash flow and price to earnings telling different stories on a stock, I am going to, I'm going to overvalue that price to free cash flow. So for today's video, I'm going to leave it at any, since I already kind of did a valuation one here. Sales growth, positive. I think that's pretty straightforward. Return on assets. We obviously want this to be positive, and I think we're going to go with over 10%. But again, if you guys are going to do this on your own, don't get hung up on some stuff. Oh, wow. We're down to 12 stocks now total. Was it this one that did it? I was not paying attention. It was. So return on assets, let's go over 5%. Just so we get a little longer list. Long-term debt to equity, not going to be too worried about that right now. For me personally, that's something I'm not going to screen for. Rather, I'm going to look a little closer after the fact. Okay, what's their debt situation looking like? Obviously, that does matter a lot. But in terms of screening, I'm kind of just going through the stuff that's like a little more clear cut to me. Payout ratio, again, we don't want it to be too high. However, different stocks do have kind of that different lens. We've talked about Altria on this channel, and they do have a higher payout ratio. And we've discussed, why that kind of makes sense for a company in the tobacco sector or the tobacco industry, right? So I'm going to be a little conservative here, and I'll go with under 70%. Okay. Or would that be conservative? It's going to be conservative in the sense that it's going to include more stocks, right? Under 70%. I'm not going to be too focused on this short float just because, I think this is more relevant to kind of small cap traders and investors. They don't want to get caught up in any sort of like, the float short gets too high and it just crashes the stock price. People start selling stop losses and stuff like that. This is not going to be as relevant for us who are more in the mid to large cap kind of lane. Performance two. does that even mean? We got performance and performance 2. We're not going to worry about it. 50-day SMA, again, I'm skipping that. 50-day high and low. No. Beta, if you want to use beta, you can. However, here's kind of my take on that. If I focus on creating a portfolio that is diverse enough for my own personal risk tolerance, guys, the portfolio beta is going to be something I'm comfortable with. So while individual stocks might have a little higher beta or a little lower beta, I'm going to get kind of something close to 1 theoretically, maybe a little higher depending on your age. However, I'm not going to lie, I don't think I've ever put too much value on the beta of an individual stock, and that's just me. Okay. Again, I'm not going to steer you guys away from anything that you like or anything that works for you. Industry, no, we're going to skip that. PEG, EPS growth. I'm going to leave this at any because we already did do kind of this EPS growth in the past 5 years. And as a long-term investor, I'm really more focused on that 5-year window. That'll tell me, more of a story of, okay, what's the opportunity today? I'm not going to get hung up on a little shorter term stuff like this. Return on equity will probably I want to go over 10%. Let's see how that affects. It didn't take out any. I wish there was like an over 12.5%, but we'll stay conservative. Return on assets, I did over 5%. Return on equity, I did over 10%. Debt to equity. What do we want to do here? We want it to be low. However, kind of with this more conservative vibe we're going with in this video, I am going to just go with under 1. Again, you could get more aggressive here if you want, but I'm just kind of talking through stuff I do consider. So any of these blue things, any of these blue boxes you see lit up, that is something that I like to look at kind of in that preliminary screen, okay? Again, this isn't going to spit out buys. It's just going to spit out, why am I saying spit out? It's going to return, okay, maybe companies I could look at a little more. And even if I don't buy them, I could learn something. Wow, T. Rowe Price. That's cool to see. I've talked about that. That is one I'm buying right now. I don't know when that video came out, but I have a video called Loading Up on This Stock or something. It's got like a green thumbnail. I'll link it at the end of this video. If you guys want to see kind of what this looks like applied to one stock, and that's always great to see, something you're interested in get spit out in the screener. I have been buying. Let's not get on a tangent. Insider ownership. I already touched on this. I don't like to get too caught up on this because, what if the CFO wants to buy a yacht and he sells some of his shares? Do I want that to affect kind of my mindset? For me personally, no. I like to keep things simple, understandable, and I'd like to try to eliminate as much sort of conjecture as I can from my investing philosophy, guys. Again, this is me. Analyst recommendations. I'm going to say no. I'm going to say for me, I don't really. If you're an individual investor, you are the analyst, okay? If I'm buying stocks for my portfolio, I'm the one who has to analyze them. So why? I don't know. Don't get too caught up in this, guys. I'm drawing a blank of his name right now, but who's that guy people are always making fun of for his crappy, stock picks? Oh my gosh. He's on TV. I can't remember his name right now, which is actually kind of crazy because I feel like I've referenced him before. Anyway, moving on. Volatility. We're not going to look at, kind of that weekly volatility. 200-day SMA, no. 52-week high and low. if you're trying to be opportunistic, you could definitely look at like 52-week high and low. Has it made a new low? Because maybe a company's made a new low while their fundamentals have kind of stayed in check. That could kind of symbolize an opportunity for you. But in this video, I'm not going to put anything. Price. With all these other screeners, you're probably not going to run into like any penny stocks. So don't worry about that. True range. Not even really too sure how to use that, if I can be transparent with you guys. A measure of stock volatility. EMA 14 days of the true ranges. Okay, so it looks like that's kind of an indicator. It's not something I've ever used in the past. I'm not going to front. Expense ratio. There's not going to be an expense ratio on individual stocks. So let's not worry about that. Country, USA. That didn't change anything. Oh, I guess it did. I put USA because I am more focused on stocks headquartered in the US. And you might say, oh, you need global diversification. I agree. I'm going to get that global diversification from companies that are, have globally diversified revenue. Okay. This video is getting a little long. Price to sales. It's another valuation metric. I do like to use price to sales sometimes. However, I feel it's more applicable to like higher growth names than I'm typically interested in my dividend growth portfolio. And that's just me. I prefer using PE and price to free cash flow. Price to sales for profitable companies, it's not really my favorite thing. Again, expectations, sales. I'm not getting too into any of the short-term stuff or, projections, analyst, ROI. We'll just put positive because typically I'm more into ROA and then return on equity. Oh no. So we'll just put positive there. We've touched on margin, guys. So, this video is getting a little long. So let's go ahead and see. This screener right here gave me 11 stocks. It returned APD, BKE, Buckle. That's interesting. Cisco, Coterra, Devon Energy, EOG Resources. What in the world, dude? We need to wrap this video up, guys. I hope you learned something today. I hope kind of this conversational style. What is that noise? I hope kind of this conversational style got you guys thinking about, okay, I need to create kind of this process. I need to learn as an investor what works for me. Okay. There's a lot of different fundamentals. There's going to be different people telling you use different things. I'm not saying you need to just care about exactly what I care about, but you do need to practice. You do need to say, okay, what works for me? I tried this out. Wasn't really feeling it. So now what kind of ways do I see value? What kind of metrics help me read and understand the story of a company, guys, and also the valuation? Can I get that bang for my buck I'm looking for as a dividend growth investor, guys? Thank you for tuning in today. It's been a great year. This will come out in March, but I'm really excited about where this channel's going. This is a more laid back video, and I appreciate you guys for putting up with that. Like I said, it's been kind of a hectic Sunday, but everyone have a great rest of your day. Let's continue to build wealth, and I will catch you guys in the next one.